nowadays, all the central bankers, they're all central planners, and they're all, I think, communicate with one another, and it's all premeditated. What the ECB says, the Bank of England, the BOJ, the Fed, I think they all kind of, have their little powwow and determine, what direction we need to go, or what does the rhetoric need to look like? What's the narrative that we need to push? And as of the last, let's just call it year, they've all been on this. We got to tackle inflation. We got to tackle inflation higher for longer, higher for longer. I think they are doing that really to talk down the markets, to try to maybe increase unemployment. And in their minds, that's going to bring down the rate of inflation to their target, let's say 2%. But what was astonishing, really, is that Jerome Powell came out the other day and basically implied that we've got this Powell pivot now, once again. And he went from being very hawkish with his rhetoric to quite dovish. But, we as American investors focus exclusively on Jerome Powell. But I think we've got to look at what the ECB is doing and also what the Bank of England. And when you look at their rhetoric, they've came out and made public appearances since Jerome Powell came out, and they're still very, very hawkish. So for me, that's interesting, because why all of a sudden are they delivering a message that's different when they're almost always on the same page, but behind the scenes, they're talking amongst one another, and everything that they do is pre-planned. So I think you've got one of two options here. And again, I'm just speculating. I don't have any proof of this. I'm just trying to use some common sense and connect some dots here. But I think that behind the scenes, Jerome Powell is really freaked out about one of two things. Either the U.S. economy, he has information, he has intel that we don't have access to, that's telling him that the economy is way, way, way weaker than he thought. And this has changed over the last, let's say, even the last couple of weeks. So this has happened very recently. Or he's worried about the dollar. He's getting information from other central bankers that the dollar, even though it's gone down recently, still anything over 100. And a lot of these other countries are having huge problems. I think one of those countries could be China right now. And that they've got to give them they've got to throw them a life raft, basically. They've got to give them some way to get out of this pressure of having the dollar at over 100. Let's say it's dollar-denominated debt, whatever the reason may be. To me, those are the only things that make sense, because you've got to look at this through the lens of psychology. Sure, Jerome Powell can come out and say that he's got the mandate for this and the mandate for that, but at the end of the day, he's human. And he's also, I think 65, maybe in his upper 60s. This is kind of his last hurrah. So history is going to remember Jerome Powell as either Arthur Burns or Paul Volcker. And you've got to put yourself in his shoes. He's thinking about that daily. He has to be. There's no way that that's not going into his decision-making process, even if it's just subconsciously. How are his grandkids, how are his great-grandkids going to remember him? I think unjustly, we look at Arthur Burns as kind of just a spineless weakling. And then you've got Paul Volcker as this cigar-smoking, legend that's in there that had the balls to do what it took to get inflation down. So obviously Jerome Powell wants to be remembered more so as Paul Volcker. So you've got to think about that. Looking at it through that framework, he still came out with this pivot when inflation is still above 3%. So again, that tells me that there is a huge, huge problem that he knows about that he's not admitting to. Now, whether that problem again is the dollar being over 100 or the U.S. economy is tanking right now, I don't know. The yield curve would imply it could be both. If they're going to cut by 75 basis points, is that really going to improve the economy? Maybe. Now, if, again, let me back up here. If we had a normal looking yield curve, Fed funds was at 5.25%, and let's say the 10-year yield was at 7% or 7.5. Yeah, I think there's some merit to that. But right now, the 10-year Treasury yield is under 4%. It's shocking that a lot of these experts in the mainstream financial media, they kind of ignore this elephant in the room, and that's the inversion of the curve. And it's not just inverted, for heaven's sakes. The 10-year Treasury yield is over 125 basis points under Fed funds, the overnight rate. So show me the last time we had a 125-point inversion and that ended well, right? So again, I think Jerome Powell, he's not stupid, and he understands that the bond market, the treasury market, is screaming at him hard landing. It's not saying soft landing, no landing. It's screaming hard landing, recession, depression, financial crisis, collapse, whatever you want to call it. That's the message. And he knows that the bond market, the treasury market, is almost right every single time. I'd like to remind your viewers that we have never had a recession, or every single recession that we have had since 1950 has been preceded by an inversion of the curve. And right now we've had the most extreme inversion that we've almost ever seen. And a lot of people think that the bond market is predicting what the Fed is going to do. I don't see it that way. I think the bond market is signaling what the health of the economy is. And that they're signaling that the health of the U.S. economy, and the global economy for that matter, is extremely poor. And therefore, the risk of recession is extremely high. So that's what the bond market's betting on. And does that mean that the Fed's likely going to cut rates? Yes, it does. But I think first and foremost, it's a signal on the economy. I think the two-year Treasury going down by 40 basis points the other day. I mean, just, prior to the meeting, I think there was a slight, I forgot what the news was that came out, but it was relatively dovish. Right? And we saw the two-year Treasury yield, which usually the Fed follows. I mean, if you pull up a chart of the two-year Treasury yield and Fed funds, it's like the Fed funds lags it by like 6 months. I mean, it's almost in lockstep. So I think that he saw the two-year Treasury the other day go down. I believe it was from it was 475. I don't have the chart in front of me, but it dropped by like 40 basis points in one day. I mean, that is almost unprecedented. And so he's looking at that and saying, whoa. Maybe, we're not heading for a no landing. Maybe we're heading for a crash landing. But you also have to understand that these regional Fed banks, they get a lot of information. They do a lot of surveys from local businesses, from commercial banks, and, all these things. So I think they call it the brown book. They aggregate that data into, or the beige book, something like that. So he has access to that boots on the ground intel as well. So he's probably looking at that, combining it with the macro, and then looking at what's happened with rates and the price signal that he's getting from the bond market. And that's what likely has him spooked. If it's not all these other central banks calling him about the dollar, or maybe it could be both. I think the reason you see the dollar go down is just rate differentials. I think that's all there is to it. I think that the market's reading that as though the Fed is going to lower rates and the ECB, Bank of England, might be a little more hawkish. We've got to remember the DXY. That's how I'm measuring it. It's like 57% euro. I think it's just in the short term, rate differentials can really move currencies. I don't know how much that really applies over the long run. But in the short term, I think that's what's driving the dollar down. It's just that the Fed, it's the prediction. It's what you're seeing in the bond market as well. The prediction that the Fed is going to drop rates, ECB, BOJ, the Bank of England might hold off a little longer and therefore strengthen those currencies a little more relative to the dollar. But you've got to ask yourself, do you think the probabilities are highest, or what's your base case? Is it going to be no landing, soft landing, or is it going to be hard landing? Because if your base case is hard landing, then you've got to be a little bit more bullish on the dollar, right? Maybe in the short term it goes down, but if we have a GFC type of event, that's likely going to be bullish for the dollar. Now, over the long run, who knows? It depends on what the central planners, how they respond to it. Could the dollar go down? And again, let's just look at the DXY. Could it go down to 70 or something? Sure. But I think the probability of it going to 130 is higher than it going to 70. And the reason I say that is because of the way the global monetary system is structured. If you get a mortgage tomorrow for $500,000, all else being equal, the money supply has gone up by $500,000, right? Because those currency units were lent into existence. Now, if I lend you $500,000 bills, now all of a sudden M2 did not increase, right? Because those currency units already were in existence. Now, let's just assume for a moment that you decide not to buy the house. So you pay back that $500,000 the bank just lent you the very next day. Then what happens to the amount of currency units? It goes right back down to where it began, right? So those currency units were created when the debt was created, and then they were destroyed when the debt was paid off. Now, again, let's go back and use that example of me lending you $500,000 $1 bills. No money was created to begin with, right? Well, when they printed it, it was created, but it's not when I lent it to you. And then when you pay me back the next day, those $500,000 $1 bills still exist, right? So it's much, much, much different when M2 money supply, the majority of M2 money supply, is dollar bills versus dollars that are created by a bank by lending them into existence. So now let's look at this. And now that we understand that dynamic, now let's go ahead and think about this. Let's assume for a moment that Saudi Arabia came out tomorrow and said, okay, we're no longer accepting dollars for our oil. We're going to accept yuan or whatever it is. And therefore, let's just assume that demand for dollars decreased by $10 trillion, just to keep the math easy. And let's also assume that if you look at the aggregate balance sheet of everything outside the United States, let's say we've got $70 trillion on balance sheets outside of the United States. Now, those $70 trillion were lent into existence. So let's assume that the demand goes down by $10 trillion. What would that do to the supply of dollars? It's going to bring it down by 10 trillion. Because what's going to happen is you've got that $10 trillion, the $70 trillion worth of dollar-denominated debt. Now, if no one wants those $10 trillion, they don't just, they just keep circulating. What happens is they go onto some balance sheet that actually owes the debt. And they say, we don't want these $10 trillion anymore. We're just going to continue to do business in the ruble, and we don't want to be held hostage to the United States through the SWIFT system, whatever. So we're just going to go ahead and take these $10 trillion that we don't want anymore, but we still have the liability. We still have the $10 trillion worth of debt. So they take those $10 trillion, they pay off the debt. What does that do? That decreases the supply of dollars by $10 trillion. You see, so effectively, it's really weird, and it's tough for people to get their head around. But the bottom line is that when you have the majority of currency units being lent into existence, let's say we had a pie chart of all the dollars globally compared to all of the Argentinian pesos, right? That pie chart is going to look a lot different for the dollar than the Argentinian peso, meaning that there's a much larger percentage of Argentinian pesos that are literally pieces of paper, or they were printed into existence, versus the dollar, where the vast majority of them, especially outside of the United States, were lent into existence. Well, let's just, again, go through that thought experiment. So let's assume that the $10 trillion that nobody wants anymore, they sell those dollars, they buy rubles or buy yuan, buy gold, whatever. And the argument there is, well, oh my gosh, all those $10 trillion dollars, those will come they'll flood into the United States because no one wants them anymore. And it'll create hyperinflation in the United States. You got $10 trillion coming in. Well, that's true. That's absolutely true. But it doesn't mean that the dollar goes down versus other currencies, because think about that. You would still have the $70 trillion worth of dollar-denominated debt. Therefore, the $70 trillion worth of liabilities outside of the United States. But now, all of a sudden, instead of having $70 trillion on the asset side of the balance sheet, you only have 60, because 10 trillion of those dollars are now circulating inside the United States. So now think about the equilibrium. Instead of having 70 trillion on the asset side and 70 trillion on the liability side, now you only have 60 trillion on the asset side. So if that happened, it is true that you would see some serious consumer price inflation in the United States, but you would also see the dollar skyrocket relative to other currencies, because you still have that intrinsic demand for those dollars because they were lent into existence. And that dollar-denominated debt is still a liability that has to be paid off. And if your viewers want an example of this, just look at the last 20 years. Just pull up a chart of the DXY, right, and then pull up a chart, or let's look at the last couple years. That's the best example, because if you look at the dollar in 2019, it's higher today than it was in 2019. While at the same time, we had consumer price inflation skyrocket in the United States, up over 9%. So while consumer price inflation was going up in the United States during 2021 and 2022, the United States dollar on the DXY was going up in value relative to other currencies. That's very difficult for people to get their head around, that the dollar outside of the United States, it's like a completely different currency. You got to treat it as though it's its own thing. And that can appreciate very rapidly, and that can appreciate greatly against other currencies, while, oddly enough, it's losing value relative to goods and services in the United States. I would trust the banks if the government was not so involved. I mean, right now, let's face it, Bank of America, Wells Fargo, JP Morgan, they're basically extensions of the government. So if we could go back to free banking that we had in the 1800s, yeah, I'd trust the banks, because all those loans, they'd have to keep them on their balance sheet. No one's there to bail them out. But now, no, I don't really trust the banks. But you bring up a great point. We were talking initially about what may be motivating Jerome Powell to take a huge risk to his reputation, for the next, and how history is going to remember him by doing this pivot. But he could be looking at the health of the banking system with the BTFP. And so just as a reminder for your viewers, back in March, when Silicon Valley Bank went bust, the Fed kind of set up this special program, another tool that they have. It's called the Bank Term Funding Program, I believe is what it stands for. It's the BTFP. And when that was set up in March of 2023, when all these banks were going bust, Signature, First Republic, etc., the utilization of the BTFP went straight up to 60 billion, 60 with a B, because what this was doing was allowing these banks to take the treasuries that they owned, that they took a haircut on because interest rates went up, giving them to the Fed and getting 100 cents on the dollar. So if this BTFP is being utilized, that tells you it's kind of like a proxy for the health of the banking system. Well, most people think that BTFP is no longer being utilized because we don't hear about it anymore. To your point, we think that the Fed came in on their white horse, saved the day, and now all of a sudden we've got nothing to worry about. Oh, that banking crisis. Oh yeah, that's old news. No. If you look at the BTFP right now, it's at an all-time high as far as its utilization, and it actually just spiked up. So just to give you some context there for your viewers, back in March of 2023, when we had all these banks going bust, the utilization went straight up to about 60, maybe 65 billion. Wow. Today, it's at 120. So you could argue that the system is twice as bad as it was in March of 2023. That could be another input to Jerome Powell's decision-making process. You have to think about this, right? Would any of your viewers argue that we would not have had a banking crisis or a GFC 2.0 if the Fed would not have bailed them out in March of 2023? No one would argue that. Everyone, I think, would say, yeah, absolutely. If the Fed would not have stepped in, then we would have had a GFC 2.0 in March of 2023. I mean, if you just take the balance sheets of the banks that did fail, all of the balance sheet, the assets were larger than the banks that failed combined in 2008. So it would have been catastrophic, right? And now we have to realize that BTFP is being utilized to a greater degree, twice as much as it was in March 2023. So if they did a rug pull on that BTFP, I can assure you we would go straight into something that would look a lot worse than what we saw in 2008 and in 2009. So and the reason I'm pointing that out is just to show you the fragility of the system right now when we think that the problem has been solved.